In 2001, Enron was the seventh largest company in America. Wall Street loved it. Analysts rated it a strong buy. And yet, anyone who spent 10 minutes reading its balance sheet would have seen the disaster coming. Today, I'm going to teach you how to read a balance sheet, the same skill that separates informed investors from everyone else. Welcome back to Daily Investor. A balance sheet is the single most important financial document a company produces. Warren Buffett has said he reads hundreds of them every year. Benjamin Graham built his entire investment philosophy around them. Yet most individual investors have never read one. That changes today. In the next 10 minutes, you'll understand exactly what a balance sheet tells you, how to spot strength, how to spot danger, and how to use it to make smarter investment decisions. This is educational content, not financial advice. Always do your own research. Every balance sheet in the world comes down to one equation. Assets equals liabilities plus shareholders' equity. That is it. Every publicly traded company, from a corner bakery to Apple, follows this exact formula. Think of it like a house. You buy a home worth $400,000. You put $100,000 down and take a $300,000 mortgage. The house is your asset. The mortgage is your liability. And that $100,000 of your own money, that is your equity. Simple as that. Assets are everything the company owns: cash, buildings, inventory, patents, equipment. Liabilities are everything the company owes: loans, unpaid bills, bond debt, lease obligations. And equity is what is left over for the shareholders after all debts are paid. If you remember nothing else today, remember this: equity is the true net worth of a business. Let me show you a real example. As of September 2024, Apple reported total assets of approximately $364 billion. Total liabilities were about $308 billion. That leaves shareholders' equity of roughly $56 billion. The balance sheet balances, it always does. That is how you know you are reading it correctly. Now that you understand the structure, let me show you where experienced investors actually focus. There are three numbers I check before anything else. Number 1, the current ratio. This tells you whether a company can pay its short-term bills. You take current assets and divide by current liabilities. A ratio above 1.0 means the company has more short-term assets than short-term debts. Below 1.0, and the company might struggle to keep the lights on. Let me show you why this matters. In 2008, Lehman Brothers reported a current ratio that looked acceptable on the surface. But hidden inside those current assets were billions in mortgage-backed securities that were about to become nearly worthless. The balance sheet technically balanced, but the quality of the assets was rotten. This is why you don't just look at the numbers, you think about what is behind them. Number 2, the debt-to-equity ratio. Total liabilities divided by shareholders' equity. This tells you how aggressively a company is borrowing. A ratio under 1.0 means the company is funded more by owners than by lenders. A ratio of 2.0 or higher means the company owes twice as much as the shareholders have put in. That is a red flag in most industries. Consider this. As of early 2025, Costco carried a debt-to-equity ratio of roughly 1.3. Compare that to a company like Boeing, which has had negative shareholders' equity in recent years, meaning liabilities exceeded total assets. When equity goes negative, the debt-to-equity ratio breaks down entirely, and that alone tells you something important about the financial health of the business. Number 3, retained earnings. This is found in the equity section and represents the cumulative profits a company has reinvested into itself rather than paying out as dividends. A company with large, growing retained earnings is a company that has been profitable for a long time and keeps plowing money back into the business. Berkshire Hathaway, for example, reported retained earnings of over $630 billion as of late 2024. That represents decades of Warren Buffett reinvesting profits instead of paying dividends. Now let me teach you what to watch out for. These are the warning signs that show up on the balance sheet before they show up in the stock price. Red flag number 1, goodwill that keeps growing. Goodwill is an intangible asset that appears when a company buys another company for more than its book value. A small amount is normal. But when goodwill makes up a huge percentage of total assets, it means the company has been overpaying for acquisitions. If those acquisitions don't work out, that goodwill gets written down and shareholders take the hit. A dramatic example: in 2000, AOL merged with Time Warner in a deal valued at $164 billion. By 2002, Time Warner wrote off approximately $99 billion in goodwill. That is nearly $100 billion of shareholder value that simply vanished from the balance sheet. Red flag number 2: debt growing faster than revenue. If a company's total liabilities are climbing year after year but revenue is flat or declining, that company is borrowing to survive, not borrowing to grow. That is a dangerous pattern. Red flag number 3: shrinking equity. If shareholders' equity is declining over several quarters, it means the company is either losing money, buying back stock aggressively with borrowed money, or both. A sustained decline in equity should always prompt deeper investigation. Let me give you a practical framework you can use on any company, starting today. Step 1: look at total assets, total liabilities, and equity. Get the big picture. Is equity positive and growing? Good sign. Step 2: calculate the current ratio. Is it above 1.5? The company can comfortably pay its short-term obligations. Step 3: calculate the debt-to-equity ratio. Is it below 1.0? The company is conservatively financed. Between 1.0 and 2.0? Moderate. Above 2.0? Investigate further. Step 4: check goodwill as a percentage of total assets. If it is above 30 or 40%, the company has made big acquisitions that may or may not pay off. Step 5: compare this year's balance sheet to last year's. Are assets growing? Is debt stable or shrinking? Is equity increasing? Trends matter more than any single snapshot. That is the same basic process Benjamin Graham described in The Intelligent Investor back in 1949, and it works just as well today. The balance sheet is the foundation. Everything else, earnings, cash flow, valuation, builds on top of it. Here is the one thing I want you to take away from today. A balance sheet is a snapshot of financial truth. The income statement tells you what a company earned. The cash flow statement tells you where the money went. But the balance sheet tells you what the company actually has and what it actually owes, right now. As Benjamin Graham wrote, in the short run, the market is a voting machine; in the long run, it is a weighing machine. The balance sheet is that weighing machine. Learn to read it, and you will see what most investors miss. If this helped you understand balance sheets better, hit subscribe. We put out a new investing lesson every single day. Tomorrow, we are diving into how to read an income statement, so you will have the second piece of the puzzle. Drop a comment below. What company's balance sheet do you want me to analyze? I read every single one. Until tomorrow, stay patient, stay disciplined, and always do your own research.